Why the Federal Reserve is intentionally causing a recession and contraction in the United States economy. I have all the details and what you need to know right here in the video, so let's get right into it. All right, now in this video, I want to discuss what the Federal Reserve is currently doing, what is their objective, and what does all of this mean for us going forward through the rest of 2022 and into 2023 with their aggressive policies and what the Federal Reserve is doing right now. So let's get into it and discuss all the details, as we have a lot to cover right here in this video. It all comes down to inflation, our favorite word of 2022. Yeah, right? So anyway, it all comes down to inflation. So let's quickly talk about what the Federal Reserve is currently doing right now and ultimately what their objectives are and why they are doing what they are actually doing, and is this actually going to work? So we have a lot to talk about. Let's get through these. All right, so number one, what is the Federal Reserve currently doing? Well, as a result of all the inflation that we're currently dealing with right now, the Federal Reserve is aggressively raising interest rates. Now, over the last couple meetings here, they've been coming out raising interest rates by 75 basis points. To put that into perspective, the last time that the Federal Reserve raised interest rates this aggressively was way back in 1994. 28 years ago, nearly 30 years ago, was the last time that they raised interest rates at 75 basis points. So you can see the current situation that we're currently dealing with right now is probably pretty important, considering they're making moves right now that they have not done in 30 years, or they're about 30 years, right? Very, very important. So the last couple meetings, they've been raising interest rates by 75 basis points. Now, what does this actually mean, and how is this actually going to lower inflation? Let me talk you through the details about this. So here's what it all comes down to. Up until about the beginning of 2022, so just a few months ago, it wasn't even that long ago, beginning of this year, interest rates were very, very low. In other words, it was almost free to borrow money. Now, obviously, it wasn't completely free, but interest rates were so incredibly low to borrow money on virtually everything. A 30-year fixed-rate mortgage, a 15-year fixed-rate mortgage, auto loans, home equity lines of credit, personal loans, business loans, literally anything. It doesn't really matter any kind of debt product that you were trying to get at the time. Basically, all debt products and anything out there in order to borrow money was very, very cheap. It was like so cheap to borrow money, a lot of people were doing it. So as a result of that, there was a very high appetite for people, as in consumers and businesses, to go out and borrow money, because why wouldn't you? It was almost free to do so. You could borrow tens of thousands or hundreds of thousands, or in the case of businesses, millions upon millions of dollars, and pay it back with a very, very low interest rate. 2%, 2.5%, maybe 3% in some instances, depending on the type of loan. The fact of the matter is, interest rates were incredibly, incredibly low, which, by the way, as of right now, for example, a rate on a 30-year fixed-rate mortgage has doubled since it was what it was at the beginning of this year. So money is not that cheap anymore. Interest rates have gone up significantly. So as a result of that, as appetite was very, very high and demand was very, very high for cheap money, is what it's called. That's what people call it. It's cheap money. It just means that interest rates are very, very low. As appetite and demand was very high, a lot of people were going out borrowing money. As a result of that, that money was flowing back into the economy. People were buying goods and services. People were buying all kinds of different things. Businesses were buying inventory. There was a lot of different things because a lot of money was cheap. A lot of people were borrowing money, and they were going out into the economy, spending it on goods and services and all kinds of different things. Therefore, inflating prices, because there was so much demand for the same amount of goods and products and services that all of a sudden it inflated prices significantly. One example that I want to give you, look at the housing market. It has inflated huge over just the last couple of years here, because so many people have been going out getting record low interest rates on mortgages, 2.25% on a 15-year, 2.5 or 2.75% on a 30-year. This was earlier this year. Very, very cheap. So you could buy a house with very low interest rates. You could lock in very, very low. So a lot of people were coming out into the market buying homes, buying real estate, and driving those prices higher because they were paying such a low premium on that interest that they were paying back to the bank to borrow that money. Kind of makes sense. So that's one good example of one of the products that's out there, one tangible item that's getting driven up in price because of low interest rates. All right, so as a result of that, The whole idea behind the Federal Reserve to lower to lower inflation is to come in and raise interest rates. As a result of raising interest rates, people like you and me and businesses and other people all across the country are less interested in borrowing money, because all of a sudden, if you could borrow money at the beginning of the year for, say, 3%, and now it's going to cost you 6%, are you very interested these days? I'm not sure about you, but I'm not interested in going out and paying double the interest that we once were, say, 6 months ago or 8 months ago, at the beginning of the year, things like this. So why would people go out and borrow money now, today, with higher interest rates when, if they were not interested at the beginning of the year, why would people be interested now, right? Well, that's the whole idea behind what the Federal Reserve is doing. Raising interest rates to make it more expensive to borrow money so that less people are interested, less people, businesses, and everybody else is interested in borrowing money. As a result of that, with less money being borrowed, that means less money being spent on goods, services, inventory, and all kinds of different things like that, driving prices higher. Do you see how this whole system is working out now? It's like a big circle, right? So as a result of that, the Federal Reserve is aggressively raising interest rates to get us, the people and businesses, to stop spending money, which ultimately, if we stop or slow down our spending on goods and services and the products that we buy on our store shelves, as a result of that, that means less demand for those products. When there's less demand and equal to or more supply, that means prices must come down. Simple economics 101, right? So, as a result of this, they want to lessen demand in the marketplace. They want to have people spend less money. They want us to save more money. One other interesting point that I want to throw out as well. When interest rates were very low at, say, 2%, 3%, something like this, how much money were you getting in the bank in your savings account? Zero. I'll just answer for you. It was zero. If it was anything, it was maybe like 0.1%, maybe 0.2%, maybe if you're lucky. It was practically zero. So the incentive to save money in a savings account was nothing. There was no point. Why would you save money when you're getting nothing for it and inflation is sitting at 9%, right? Just doesn't make any sense. You're losing about, a lot of money because of inflation. Well, as a result of that, now that they're raising interest rates up, guess what's going on right now? Interest rates on savings accounts is also going up as well. So if you continue to watch your savings account, if you have one, and you look at your interest rate, it's probably moving up significantly, from what you've seen maybe 6 months ago, 8 months ago, 9 months ago, things like this. It's probably gone from maybe 0.1%, maybe 0.2%, maybe up to even 1 or 1.25%, maybe even 1.5%, depending on where you're sitting now. So that's a huge increase in interest rates on savings accounts as well. So now it becomes less appetizing to actually borrow money because it's going to cost more, and it's now more appealing to save money because you're getting, say, 1%, 1.25%, maybe 1.5% on your savings account. So now it's more appealing to save money, right? You kind of see how this is all working out? So here's the objective of the Federal Reserve. The Federal Reserve is raising interest rates to get us to stop spending money, to save more money, and to ultimately decrease demand on products and services and virtually everything in the marketplace. As a result of that, inflation should come down. But the problem is, it's going to take a very long time. This is not like a one thing where they can just come in, flip a switch, and all of a sudden, hey, check it out, we lowered inflation this month. It doesn't work that way. It's a very slow process, especially with the Federal Reserve not coming in aggressively raising interest rates more than they are right now. Yes, they're doing 75 basis points, but realistically, if they wanted to slow this inflation down and stop it in its tracks, they would need to do something even more aggressive than that. I know it seems like it's a lot right now, but realistically, they're kind of tiptoeing into this situation. If they really wanted to slow this inflation down fast, they would need to come in and raise rates like very, very high, really, really fast. And as a result of that, it would stop this inflation very, very quickly. However, that is one function of the total situation that we're dealing with right now. The next situation is too much money supply. Now, I've talked about this in previous videos, but let me break this down for you really fast here. In the last couple of years, from early 2020 up until basically currently, well, actually not currently, up until about the beginning of 2022, the federal government printed about $6 trillion. That was about 22% of our total money supply around the world. So the United States dollars, about 22% of the United States dollars were printed in just that, say, 2-year period of time. That's a lot. So basically what it comes down to, there's too many dollars chasing too few goods and services. Again, economics 101, too much money supply. So what the Federal Reserve needs to do since they printed $6 trillion, they need to start getting some of that money out of there. So there's too much money chasing all of the goods and services. So as a result of that, they need to come in and start taking money out of supply. Now, that does not mean that they're going to come in and take money from us. That is not what it means. It just simply means that there's too much money out there. So when they print money, what they do is they buy bonds. Right? So, they need to reverse that and start getting money out. They need to decrease the money supply. So let me give you one quick example. Let's just say, for example, let me think of an example really quickly here. Okay, let me give you this example. Let's say that you walk into the grocery store and you go over to the bakery section. There's 10 pies on the counter, right? There's 10 pies on the counter. Well, as a result of all the 10 pies, and you have 8 people out there, there's 8 people standing there waiting to get the pies, and there's 10 pies. Do you need to fight for all the pies on the shelf? No. Everybody walks up, they grab a pie, and they walk away, and 8 people get their pies, and there's 2 pies left. Is there any there's more supply than there is demand, right? Does that kind of make sense? So there's more supply on the shelf of pies. There's 10 pies, and there's 8 people with demand to buy those pies. Well, as a result of that, there's still 2 pies left over. There's nobody out there bidding up the pie price or anything like this, and it doesn't really matter. That's the problem, right? Well, the situation that we're dealing with now is that all of a sudden, now we have, let's just say there's 10 pies on the shelf, and now we have 20 people. The people represent the dollars, right? So the dollars, the people represent the dollars, and the pies represent the product or the service. And now all of a sudden, we have 10 pies sitting on the shelf. We have 20 people out there, and all of a sudden, they open up the gate, and all 20 people rush the shelf, and they basically wrestle all over the pies, right? They wrestle each other for the pies. Well, what do? Maybe rather than wrestling each other, because I would hope that we're in a civil situation here where we don't need to wrestle each other for a pie. I mean, seriously, it's a pie. Just like calm down, people, right? You know what I mean? So the fact of the matter is, people whip out their wallets and they start saying, I'll pay $20. And the other guy says, I'll pay $25. And the next guy says, I'll pay $30. Because here's the thing. There's so much money floating around out there that all of a sudden everybody has more money to start bidding up prices. Now that same $10 pie that was currently sitting there prior to the 20 people rushing the shelf is now all of a sudden going to sell for, say, $50 because now all these people are coming out saying, I need a pie. It's my mom's birthday and I need a pie for her or whatever. It's a holiday. I need a pie for this holiday, right? So now all the people out there need this pie really, really bad. So now all of a sudden they start whipping out their wallets and they start saying, I'll pay more, I'll pay more, I'll pay more. Because there's so much money in supply right now that all of a sudden they can bid these products up and they can bid up the price on all of these different products and services. Kind of makes sense? Kind of the classic definition of what inflation is, because there's too much money. Too many people out there in this example, the 20 people that had too much money in their pockets bidding up the price on these 10 pies. Kind of makes sense? It's not like the best example in the world, but it kind of gives you a better illustration of what it actually means when there's too much money supply. Well, as a result of taking some of the money supply out of the system and getting some of that supply down, well, now the people may not have quite as much, there might not be quite as much demand out there for the same old goods and services. So now we might have just a normal marketplace where 10 people walk up, buy the pies, and everybody's happy and fine and dandy. We don't need to sit here and brawl in the grocery store over a pie. Get what I'm saying? So kind of a corny example, but at the end of the day, I hope it gives you kind of a better example as far as what it means when there's too much money supply in the system, right? So what does this all mean for us? Well, at the end of the day, it's going to cost us more to borrow any kind of money. Now, unless you have some kind of fixed rate on your loan, whatever it happens to be, so let's just say that you have a fixed rate mortgage on a house. It's not going to affect you in any way, shape, or form. However, if you have an adjustable rate mortgage on a house, as in an ARM, that's what it's called, ARM, adjustable rate mortgage, well, unfortunately, you're going to pay more for that mortgage because now your interest rate has gone up. Maybe it was sitting at 2.5%. It might be sitting at 3.5% now. You know what I mean? So as a result of that, we're all going to start paying more. How many of us out there right now, and again, you don't need to leave a comment down below showing this, but I'm just saying, how many of us right now are maybe floating balances on credit cards? Well, credit cards are going to be jacking their interest rates up as well as a result of Federal Reserve increasing interest rates. That just means if you're floating a balance on a credit card where maybe you were paying, say, 19.25% interest, now you might be paying 21% interest on that same credit card. And again, that's just one example as well. So these are things and how this is going to impact us is virtually any borrowed money that we have right now, whether it's we're opening up a new mortgage, we're getting a new personal loan, we're getting a new auto loan, we're floating a balance on a credit card, doesn't really matter what it is. if you're getting any type of new debt right now that you're locking in, well, you're going to be paying higher prices for that because interest rates have gone up, virtually doubled just since the beginning of this year. So that's how it's going to impact us. And according to what it looks like from the Federal Reserve, according to what they're saying is that they might continue to raise interest rates even more here going forward. Again, less money is going to be spent in the economy because less of us want to go out and spend money that may not be, as easy to pay off. It's going to be higher interest rates. It's going to cost us more. It's going to take us longer to pay that money back because all of a sudden now we need to owe, or now we pay back we pay back the bank or the credit card company, we pay them back more interest in what we actually are borrowing from them. Kind of makes sense? So as a result of this, it's a very slow process, but at the end of the day, if each individual person spends, say, 10% less, 20% less, or we're going out and getting less loans on a monthly basis, it just means less people out there spending money on goods and services and all things like that. And as a result, prices will come down and the inflation will also come down. But at the same time, they also need to reduce the money supply in order to take some of that money out of the circulation, because that's also another key factor as well that's contributing to all this massive inflation. Kind of makes sense? I know, kind of a lot to talk about, and I know this is probably just a straight up ramble fest, but at the end of the day, I hope this kind of helps you understand what the Federal Reserve is currently doing and how this is going to impact the economy. This is going to be a long road ahead of us. This is not something that's going to happen overnight. Even though we might see inflation coming down a little bit, and I'm sure we're going to see all kinds of people in Congress and lawmakers and all kinds of people run in circles and saying, yay, 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 we did it. This is all because of us and we lowered inflation. But you know what? It's going to take a very long time. The Federal Reserve wants to bring inflation back down to 2%. That's going to take a very long time. This is not something that's going to happen overnight. It's not going to happen in the next 5 months. It's probably not even going to happen in the next year. It's going to take a very long time for the Federal Reserve, if they continue on with their trajectory right now, to bring to bring inflation back down to 2%. This is going to be a long, long road ahead of us. So anyway, hope this gives you a better perspective on what's going on right now, and the economy will absolutely get whacked as a result of this. And again, how deep are we going to get? How big is it going to be? These are all the big questions we need to continue watching and wondering, because this is a very important situation. Anyway, I hope this gives you a better perspective on what's going on right now. Again, please make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out some of the other thousands and thousands of videos here on the channel. Until next time, have a good one. Thanks so much for watching this, and I'll catch you again later in the next one. And I hope this gives you a better explanation as to what is actually going on right now with the Federal Reserve and what we can foresee coming with the economy, as well as how this is going to impact you going forward. Thanks again. I appreciate it. Enjoy your day. Subscribe, share, and go back and check out the other videos. And